Hi everyone, welcome to today's video. So right now in the market, there are three types of narratives that are going on. First is the pessimistic narrative. Now this has been led by Mr. Michael Burry, and just do a very quick fun exercise. Go type Michael Burry any month, December month, and look at his commentary. He is negative. If you go last year December, again he was negative. So he is always negative in the market and he is pessimistic. I'm not saying that he is wrong. He very well might be wrong. Markets might go to absolute zero, who knows? But that is one of the perspective that is going on in the market. Second would be the optimistic narrative. These are people like me who will keep on pointing to this quote from Mr. Peter Lynch, and you will feel that everything is hunky-dory in the market. Now third is a more realistic perspective on the market, which is led by Mr. Ray Dalio right now. He has taken a $10.5 billion short position on European market and also a large undisclosed amount of short position in the US market. What is the meaning of short? It means that he is selling today and he will be buying tomorrow. So that is what short position means. How would that be possible? For that you need to know a little bit of futures and options. So anyways, on this video, I'm going to help you understand the perspective of each of these three people, each of these three parties, so that you can make a call for yourself. A, whether to take more positions in the market or sell off your stocks. Number two, should you be hedging your portfolio? And number three, I will show you with data fact as to how these three parties are taking one collective action. They are all doing one collective thing that I think any intelligent investor should be doing. So that is the precise topic for today. Also a big shout out to our sponsors for today, which is Vested. They allow you to invest in the US stock market. In case you're looking to buy stocks like Amazon, Apple, Netflix, Google, you could consider using Vested. And also you could consider checking some of my Vest on the US market. So let us get the discussion started. And first and foremost, let us take a look at the pessimistic viewpoint regarding the market. And for this, let us analyze Mr. Michael Burry's commentary. So Michael Burry gives a very negative commentary about the economy, and he considers the supply side constraints of the economy. Now what is meant by that? I will analyze two of his tweets. So first tweet is here, and he says that we are going to see early Christmas. What is the meaning of this tweet? It simply means that during Christmas in the US, there are a lot of sales, very similar to how sales happen during Diwali in India. In the US, during Christmas time, sales happen. Now he's saying that, this year Christmas is going to come early. Why is that? Because companies are going to discount their product. Which brings us to the second tweet, and this is the second tweet. He talks about something called as bullwhip effect, and he asks people to Google it. Now I know people are not going to Google it, so I'm going to explain in very easy to understand language what bullwhip effect is and how these two tweets are related. So bullwhip effect in simple terms means that how the mismatch of supply gets exaggerated as we move down the value chain. So what is the meaning of value chain? Let me pick an example and explain. So let us consider the example of Maruti. Now in order to manufacture car, what does it need? It needs a lot of steel. And how will it get that steel? Because Maruti is not extracting steel. So what will it do? It will place pre-orders with companies like JSW Steel. And how much pre-order will it make? So let's assume 100 tons. Now JSW Steel again will not send its employee to go and excavate the earth and extract steel out of it, something like that, right? So that is not going to happen. They are going to further lend it out to suppliers. And how much order will they put? They might put 200 tons of steel, because they are not only supplying to Maruti, they are also supplying it to 100 other different customers. So this chain gets elongated with time. Now if everything is going well in the economy, that here by using 100 tons of steel, Maruti is able to manufacture 100 cars, and these 100 cars get sold. So everything is going well in the economy. But the problem happens that if on the demand side there is a sudden crash of demand, people are just not buying this inventory. If people are not just buying this inventory, that instead of 100 cars, only demand is for 20 cars, then this entire chain gets impacted. And as a result, what is it that suppliers will have to do? They will have to discount their inventory, and you will have early Christmas. So this entire process or phenomena of suppliers creating more and more supply, but there is not enough demand being created. So that is called as bullwhip effect. So Michael Burry talks about a supply chain problem, and he explains 6 steps associated with it, which I will simplify in very easy to understand language. The first step is overestimation of demand. Now, overestimation of demand means that people will be demanding more oil, shampoo, this, that. Why would that happen? Because governments have printed a lot more money. Now there is more credit flowing through the economy. So everyone is demanding more and more stuff. Something similar happened when quantitative easing took place after 2020. So this is step 1. Now, as a result, companies are going to create more and more inventory. Now, if that inventory is not getting sold because the demand turns out was not that high to begin with, then companies will start discounting their products. Now when they discount their products, it will reflect in poor earning. Now if that reflects in poor earning, people will lose jobs. And as a result, the government will have to step in and do quantitative easing and keep on repeating this entire cycle. So this entire thing keeps on derailing the economy. Now these concerns are very valid because you might have seen very recently that the job data is really worrying. A lot of startups are firing people. Even companies like Microsoft and Amazon have started firing people. LinkedIn has started firing people. So yes, this entire phenomena looks to be playing out. So now this leads us to the most interesting question that, okay, Michael Burry has really scared us and these things are actually playing out. So should we sell our portfolio and go away? Easiest thing to do is that just go and take a look at what he is doing. So some of the recent moves that he has made, and he runs a hedge fund called as Keon Asset Management, and you will see 2-3 interesting things. Number one, he has purchased Apple, and what has he done? He has not directly purchased the stock, he has purchased a put option on Apple. This is a very important point to understand, that he is hedging his portfolio. So anyways, coming back to the topic, that he is actually hedging his portfolio, and there are outright shares that he has purchased. For example, he has purchased Discovery, he has purchased Alphabet. Alphabet is Google, so he has purchased that. He has purchased Facebook. So all these stocks he is purchasing. Can these stocks go down? Yes, these can go down, but important point to note is that one, he is hedging his portfolio through FNO, and second key thing is that he is still buying despite all the negative commentary that he is doing. Now let's move on to the second category of people, which are optimists, and here I will do a little bit of technical analysis for you because I have already spoken a lot about fundamentals. So let me take you to Nifty 50 chart and let me tell you my perspective as to why I feel that markets are somewhat bottoming out. Can they fall further? Of course they can fall further, but according to me, markets are bottoming out and they should start reversing soon. So here is a chart for Nifty 50 and there are 3-4 interesting observations that I would like to tell you. So first observation is that the markets last consolidated here, and this was almost 1 year back. Markets have just been volatile after that. For example, they went up, then they went down, they went up, they went down, they went up, they went down, went up, went down, so on and so forth. But the last actual consolidation happened almost a year back. So at some point the market should consolidate, and there has already been a significant time correction that has happened. What do I mean by time correction? That after 1 year of dancing around in the markets are back to the same levels. So in 1 year, Nifty 50 has not given any gains. So this is point number one. Point number two is that what you will notice is that there are lower highs. Now what is meant by lower highs? It means that market faced resistance here. This was resistance 1, this was resistance 2, this was resistance 3, and all these resistance points are getting lower and lower. Now opposite is happening on the support. So this is support 1, this is support 2, right? This is support 3, this is support 4, and this is support 5, right? Support 5. Now, why am I plotting this? Because you will see something very interesting. When it comes to support 1, 2 and 3, there was a clear downtrend that the supports were getting lower and lower. Now here, after support 3, what has happened is that support 4 was almost at the same level at support 3. Also, a very interesting observation is this candle. What does that show? That when this fifth support was getting formed, that markets corrected in one single day a lot. Now, this is a very important observation because the market started recovering right after that. What does this indicate? So in very easy to understand technical terms, this was a V-shaped sharp recovery. Now these type of recoveries only happen when this becomes support 4, support 5 become very important consolidation points. So the markets are likely to consolidate here. So is it guaranteed that the markets are going to consolidate here? It is not guaranteed, but looking at the time correction that has already happened, the V-shaped recovery, that the markets are finding it harder to fall despite so many news, it looks likely that the markets are going to correct here. So that is the optimistic perspective. You could choose to believe in it. Now let us move to third and final type of perspective, which is a more realist perspective, which is from Mr. Ray Dalio, and he has been very consistent with his commentary. So there are 3-4 angles to Mr. Ray Dalio's commentary. So let me talk about the first angle, which is his trust on the government, and this is a quote from him. And what he says is very, very sensible. So he says that history has shown us that we shouldn't rely on governments to protect us financially. On the contrary, we should expect most governments to abuse their privileged positions as creators and users of money and credit for the same reasons that you might commit those abuses if you were in their shoes. Now please read this commentary not from a political party's perspective, but just how the government printing works. Mr. Ray Dalio has been a staunch critic of the way the governments have been printing money, and he has taken a debt-oriented position. So this is the second key point that you need to understand, that he talks about a long-term debt cycle in the economy and how it is going to wreak havoc, especially on developed economies. So therefore, he is very pessimistic when it comes to US investing and European investing. And he frequently compares the current situation, which is the 2022 situation, to the 1970s inflation situation. So back in the 70s, inflation in the US was very, very high. Now, why was that the case? The case was that US actually fought the Vietnam War, and for that it had to take a lot of debt. War is very costly, and governments actually ended up printing a lot of money. Now, as a result, what happened? Inflation happened. Something very, very similar is happening in the economy right now also, that we have had a pandemic war due to which the governments had to print a lot of money, and that has resulted into inflation. So back in the 70s also, the inflation was very, very high. Government said that we will be able to handle it. In 2022, inflation is very high. Government said at one point in time that we will be able to handle it. Guess what? In both these circumstances, governments were not able to handle high inflation. In late 70s, the inflation went out of hand, and by 1980, the inflation in the US went to 14%, which is very, very high given the US economy. So what ended up happening in the US? There were two things that happened. One is that the stock markets corrected by roughly 50% during the 70s high inflation scenario. Second key thing, there was a Fed director called as Wagner, and he brought the entire situation under control. How? By increasing the interest rate massively. And something similar is playing out exactly in the economy, and we don't know to what extent the Feds are going to continue to increase the interest rate and what havoc it will wreak on the stock markets. These days, given the volatility in the market, it is almost impossible to predict what the stock markets are going to do. It is entirely being moved by Fed decisions and government decisions. So just to wrap up Mr. Ray Dalio's commentary, post 2020, governments have printed insane amount of money. This is the total debt that nations across the globe have taken. These are very high levels of debt, and we are already seeing high inflation in the economy. How will it be controlled? By increasing the interest rate. And guess what Feds are doing now? They are increasing the interest rate. Why? Because they want to control the demand side of the equation. They want to suppress the demand. Now, if the demand gets suppressed and the economy does not move, then it will lead to something called as stagflation. And that is the reason why Ray Dalio is also doing a lot of FNO and protecting and hedging his portfolio. So just to talk about what Mr. Ray Dalio is doing in the market right now. So this quarter, he has increased his position from $17.2 billion to roughly $24 billion. So he has purchased more stuff, but he has taken short positions both in US and European markets. Please remember that yes, he has purchased a lot of stuff, but has done FNO. Am I also doing the same? Yes, I'm doing the same. I'm disclosing it to all of you. Do I do a lot of FNO during a stable market? The answer is no, I don't do that. But right now, given the volatility, it is important to protect your portfolio. Therefore, I'm doing FNO as an insurance. I'm not doing FNO to make short-term money or do short-term trading. I'm simply doing it as a hedge. Very similar to how Mr. Ray Dalio and Mr. Michael Burry are doing. Another important point from the latest quarterly filing of Mr. Ray Dalio's portfolio is that he has doubled his position in emerging economies. So by default, we as Indians invest most of our money in India, which is cool, nothing wrong with it, but you should be diversified too. A lot of Mr. Ray Dalio's money is in the US, in growth companies and defensive companies. For example, this brings us to point number 3, that right now his 3 biggest positions are in Procter & Gamble, which is a defensive stock, in Alibaba, which is an aggressive stock, and in Johnson & Johnson, which is again a defensive stock. If you compare it to Mr. Michael Burry's portfolio, he has taken more positions in technology/growth oriented stocks. Why? Because right now, and I am speculating here because this is the same perspective with which I am also operating, because going forward, growth stocks are going to do well. Why? Because there will be a bullwhip effect as the quantitative easing kicks in. So the moment the government struggle in terms of growth, they are going to print more money and growth stocks are going to skyrocket. Something like Amazon, Apple, Google, Alibaba, all these companies are going to do well. Is it a push from my side for you to go and invest? No, this is not at all a push from my side. Please make your own judgment. I am helping you understand all 3 sides of the equation. So in summary, what is it that pessimists, optimists, realists are doing? Are they buying or are they running away from the market? They are all buying. They can be extreme critics in the public, but they are buying and increasing their portfolio at a very brisk pace right now. Why? Because this is a great time to buy and consolidate your position further. Second key point, that are they simply buying and running away? The answer is no. They are hedging their portfolio also and building a sensible portfolio. As retail investors, what we do is that we are always averse to new investment options. We don't want to learn about new things. Markets can be volatile. It's a tough job to make money from the market unless you are willing to invest some time, effort, energy in terms of learning about it. If you keep on questioning everything that, okay, this is evil, that is evil, then you will not be able to make money. Please balance and hedge your portfolio. That is the most sensible thing to do. All people are doing it. Third and finally, please do not sit on the sidelines and watch the show. Every investor has an investment narrative that they are following. They are believing in that argument, and at the same time, they are hedging their portfolio not to get wiped out. As long as there is enough interest and people learn all these things sensibly, I am happy to make an FNO series. Press the like button. Get this video to 20,000 likes. I'll be happy to shoot a FNO series. I hope you enjoyed the video and you did understand the complexities associated with the stock market. And please don't just simply trust people's commentary. Look at the actions that they are taking. That is more important. These are some of the major points that you must absolutely note down. It is critical for the well-being of your portfolio. Thank you so much, and I will see you soon.